I like it when the stock market goes down. That sounds crazy, but I'm going to tell you exactly why in this video so you can develop the mindset to become a successful long-term investor. I'm also going to talk to you about 4 dividend stocks that are my largest dividend positions in my own portfolio that I'm excited about right now. Here we go, a quick look at the markets, and of course, fears in the headlines. All of the broader indexes tracked on CNBC are down. The Dow's down 300 points, the S&P 500 is down 50 points, the Nasdaq's down 84 points, the Russell 2K is down 24 points, and the VIX again is up 7%. Remember how you're feeling right now, because these are the times that in our actions, the actions we take, these are the times that inform us if we have the traits and the mindset to be successful long-term investors, or if we're better off just focusing on our job and investing in some passive index funds so we don't have to think about the market. Because the worst thing we could possibly do is react emotionally, especially after the market is already down, panic and sell our shares, because that is how we destroy wealth. Next, we're going to jump into my real money portfolio that I'm building from $10,000 to $1 million right here on YouTube, transparently over the next 10 years. I'm going to show you all of my positions, and then I'm going to show you exactly why I like it as a long-term investor when the market goes down. The secret is that we get better opportunities to buy great companies at lower prices while the businesses are still strong. And then I'm going to share 4 dividend stocks that are my top positions and why I like them and will continue to want to add more. Here's the $10K to $1 million portfolio. As you can see, current value is $22,699. We have put $25,000 in, and that means we're down $2,288 for a minus 14% return since February 15th, 2022. And immediately, that looks horrible, it feels horrible, but I'm not concerned about it because I know that I'm not investing money that I need in the next 3 to 5 years at a minimum. I'm not using margin, and I'm trying to own high quality businesses that provide important products or services that have been around in the past or that I think will be bigger and more important in the future. You might notice I didn't mention their current stock price in that equation. We invest as long-term investors in businesses, not in stock tickers. Growth Monsters portion is up 1% today. Dividend growers are down. Crypto is down. As I've shared before, and you can watch the previous videos on my channel in the 10K to 1 million playlist, I am highly focused on growth stocks right now because that's where I think the best opportunities are. And that's where, if you see this target percentage, 89%, most of my new money is going to be going into these growth stocks. Check out my latest videos where I talked about my favorite growth stocks. I'll give you a bonus and I'll just show you right here. Watch what I do. Don't just listen to what I say. I think people's actions are better than their words sometimes. So Tesla is the largest growth position, around $1,500. GitLab around $1,500. Amazon around $1,400. CrowdStrike around $1,400. Snowflake around $1,400. And those 1, 2, 3, 4, 5 are my top 5 growth positions. We're jumping from growth into dividend growers. Right now, they're about 20% of the portfolio. But because I think that opportunity for a long-term portfolio with adding money in the future is better in growth, more money is going to growth. Pretty much nothing is going to go to the dividend growers. But I'm not going to sell these positions down. I'm just going to not add to them. But here's the top dividend growers. So giving away the secret right here. Lowe's is my top position in the dividend growth portfolio at about $1,600. It's actually, I think, the largest position in the portfolio. Advanced Auto is the second largest position at $805. The rest of these are right around $260, $270. AbbVie, Fidelity National, and Raytheon. Now let's jump into the dividend paying stocks that I'm actually most excited about. And when I do add to dividend growers, this is where I'll be focused, and I'll tell you exactly why. First up, we have Lowe's. If you've watched this channel, you know I love Lowe's. Right now, we have Lowe's trading at a blended price to earnings ratio of 16. Its normalized price to earnings ratio since 2009 is 19.6. So we already know it's trading below its normalized price to earnings ratio. That's represented by this blue line. This orange line is its price to earnings ratio at its earnings growth rate over this time. So it has grown earnings on average of 16% per year. This orange line is a price to earnings ratio of 16. We can see for the first time in really a long time since the COVID crash, even way back before that, the last time Lowe's traded down to its earnings growth rate on a PE basis was back in 2012. And so in my opinion, this is a fantastic opportunity to own and be accumulating shares of Lowe's. And on the right side of this graph, the dotted lines are its estimated price to earnings ratios based on its expected future growth from Wall Street analysts. And so it's not guaranteed, but it's a decent guide and gives us a base of expectations. So if we take this and we take it out to here, which is the orange line, again, kind of a fair value estimate, and it gives us a little bit of margin of safety based on where Lowe's has historically traded. Even if it stays at a price to earnings ratio of 16, below its normalized price to earnings ratio, we get an annualized rate of return of 14% through 2025 for a 44% total return. That's a fantastic opportunity, in my opinion, and as high quality of a business as Lowe's is. Now, we don't just care about things being cheap. We want high quality companies. One of the ways that I like to do that quickly is by using Simply Safe Dividends. I'm a paying subscriber. This is not an advertisement. It gives us a fantastic dashboard. Lowe's, according to them, has a very safe dividend rating at 93. Its dividend yield is 1.63%, which is right in line with its 5-year average. They grew their dividend by 33% in May of 2021, $130 billion market cap, and a 0.82 beta to the market, which just means it's less volatile. And the last thing we'll look at with Lowe's are these key metrics. Its payout ratio is 25%, very low for most companies. Forward payout ratio, 24, even lower. Net debt to earnings before interest, taxes, depreciation, and amortization, EBITDA, is 1.81, which is low for most companies. 59 years without a dividend reduction, that's what I'm talking about. During the 07 to 09 recession, they increased their dividend. Love those styles of companies, especially if we're in or going into a recession. Recession sales dipped, but really not that bad, 3.3%. People still need to maintain their homes during recessions, and maybe more so than previously if they're going to stay in their home longer. Maybe instead of look to move or buy a home, maybe they'll do some of those upgrades that they've been waiting on. The stock did get hit during the recession. The stock was down 52%, which is right around near what happened with the S&P 500. Last bit on dividend growth, 33% in May 2021, 18% over the last 5 years, and 24% over the last 20 years. Incredible. Next up, we have Raytheon Technologies. Since 2009, they've grown earnings at an average of 10.8% per year. They have had an average price to earnings ratio over that time of 27, which is represented by this blue line. And the orange line represents a price to earnings ratio of 15, which, as you can see, it really hasn't even come close to that since 2009. And so this black line is the price. If we take it down to a PE of 15, you're still getting a 2.2% return through December 2024. But again, it hasn't traded down there at any point over the last 12 years. And so I think it's decent to go up to this normalized PE ratio of 27. That's probably a little high. You're looking at a 26% annualized return. But even if we take that down from 27 to, say, 16, you're looking at a 5% return, or 19, which is pretty reasonable to me, you're looking at a 12% annualized return. Again, high quality company. It's not going anywhere. Important industry. We're back to Simply Safe Dividends. Raytheon gets a grade of 70 for dividend safety. They're trading at about a 2.07% dividend yield, right around its 5-year average, maybe a little low. Dividend growth in April of 21 was 7.4%. $150 billion market cap, a beta even lower than Lowe's, 0.74. Payout ratio is 47%, which is low for most companies, going down to 43% because of that earnings growth that's expected in the future. Net debt to EBITDA, 2.23 Net debt to capital, 28%, still low for most companies. Maintained their dividend during the great financial crisis. Sales went down 11%, and the stock went down 52% from 07 to 09, which is still a little bit less than the S&P 500. So it's saying they grew their dividend at 7.4% in April of 2021. Over the last 5 years, they're at a negative 5% growth rate. They were paying a 73-cent dividend from 2019 to 2020. COVID happened. They reduced that down to 47 cents. In March timeframe 2021, they raised that from 47 cents to 51 cents, and they've maintained it since then. The third company, you've heard me talk about this one before. If you haven't, that means you're not subscribed, you haven't hit the like button, and my mom's not going to send you brownies. So hit the like button. You'll get brownies from my mom. You won't get brownies from my mom. But I will be happy. And make sure you subscribe so when I talk about all these companies, you can find out. It's the best part of waking up, advanced auto parts to fix your truck. All right. So since 2009, Advanced Auto has grown their earnings on average about 13% per year. It's traded at a normalized price to earnings ratio of around 18. It's trading below that right now, blended PE of 17 for an EPS yield of 5.74% earnings per share yield. So orange line represents a PE of 15. As you can see, since 2012, it's really only traded below that once in 2017. And then during the chaos that was the start of COVID in 2020. And so right now it's trading below its average. But what I like is earnings are expected to grow. This company is buying back shares. They're increasing their dividend quite exponentially. There's a lawnmower in the background. If you can hear it, don't care. One-man shop. I do all the editing and filming myself. There's no way I'm stopping this. So just deal with the lawnmower. Just look at me. Don't listen. Just turn the sound off and read my lips if you need to. All right, it passed by. I think we're all right. That's how small my yard is. They're done. They're gone. All right. Even if it goes down to a price to earnings of 15 through December 2024, we're looking at an annualized return of 11% for a total return of 31%. Get off of here. If it stays around its normalized price to earnings ratio of 18, we're looking at a boom, bam, 19% annualized return for a 60% total return. Who knows where it'll be? They might miss earnings, whatever. This gives us a gauge. This doesn't predict anything. It just sets our mind and gives us a place to start our research. Do your own research. Don't just buy these things because some person on YouTube is talking about them. This should just be the start to our process. Let's jump over to my other fave, Simply Safe. 89 dividend safety, 2.74% dividend yield, way above its average. And so usually what that means is that the price has come down a lot, but what this really means is that Advanced Auto has really started focusing on paying a dividend and increasing the dividend. $13.2 billion market cap. I bet if you thought about that in your mind, you would think Advanced Auto is a much larger company than that because I feel like I see them everywhere. 50% dividend growth in February of 2022, very fast. I don't expect that to stay at that rate. It'd be unsustainable. A beta of 0.87%, which is lower than the market. 27% payout ratio, which is very low, giving them more room to increase that dividend. A 44% payout ratio, that's because they did just increase the dividend, still low. Net debt to EBITDA, 1.53. Net debt to capital, 51%, which is high for most companies. But because of the way their capital is structured and because of their balance sheet, that's why they're still getting a very safe rating from Simply Safe Dividends. They've paid a dividend for 15 years without a reduction, maintained it during 07 to 09. They actually grew their recession sales because when you think about it, when people have less money, same concept as Lowe's, really, they're less likely to go buy a new car and more likely to fix their cars. I think I just saw a pause of a dog running outside. That wasn't a dog running outside. That was my wife getting home. I don't mean anything by that at all. I just thought I saw pause, but then the door opened and I think it's my wife. Otherwise, I'm not sure who. There's a stranger in my house. Recession returns. So it actually went up during a recession, which isn't necessarily indicative of what would happen during a next recession. I think this is because of without looking at it, when Advanced Auto IPO'd and the size of the company at the time and the growth opportunity ahead. Anyways, that clearly beat the S&P 500 from 07 to 09. 50% growth in February 22, 68% over the last 5 years, 30% over the last 10. And so let's just take a look at what that actually looks like. So they were paying a 6-cent dividend in 19 and 20. They increased it in April, which is pretty crazy considering COVID, to 25 cents. And then bam, they just increased it again in July of 2021 to $1. And then again in April to $1.50. Pretty insane right there. The fourth company is, can you guess it? Can you guess? 3M. Good is what I call it. Good. All right, this is an interesting one. So generally, I don't like companies like 3M. Capital intensive, kind of cyclical, but sometimes these companies get to where it just makes sense to buy them because of the quality of the business, how important it is. I think we're going to do more manufacturing in the United States, and I think that would be good for 3M. I don't know for sure. If anybody tells you they know anything for sure in the markets, just never watch them again because they're lying. Beautiful little lines on here, how I use these lines. So this orange line, again, is a price to earnings ratio of 15. Since 2009, it's traded on average around 19, represented by this blue line. We can see it's only come down to the orange line, or that PE of 15, a couple of times. And when it has, there's been bad news, obviously. Everybody got scared, sold off. And just look at the return. So this is in 2012 from a PE of 14.5, which is right about where we're at, up to its normalized PE of around 19. 48% annualized return for a 39% overall return from 12/28/2012 to 11/1/2013. It happened again with COVID, down to a PE of, what's crazy is that it's pretty much at its post-COVID price to earnings multiple right now. But even from there, back up to its normalized price to earnings ratio of 18, looking at a 57% return in 8 months. I'm not saying that that's going to happen again, but this business, in my opinion, is not going anywhere. There's a lot of liabilities out there right now. I think a lot of that stuff is baked in, and this company is really too important to go anywhere. And so if we look and we take it from a PE of 1450 just to a PE of 15 through 2024, you're still looking at a 10% annualized return, which is pretty incredible. If it gets back up to that PE of 19, which maybe it doesn't, but it doesn't need to, you're looking at a 20% annual, a 19% annualized return. And so for the quality company that 3M is, this is where I want to own it, even though it's a big old boring dividend paying company, not even a dividend growth company. So jump over, Simply Safe, dividend safety 75, 4% dividend yield. I should just put my whole portfolio in this thing and collect 4% a year. Not going to do that, not financial advice. 0.7%, again, it's not really a dividend grower, and that's not why I'm invested in 3M. They have a stable dividend, in my opinion, and there's capital appreciation, meaning I think the stock price can go up because of that multiple contraction that we're currently at and just getting back to its normal multiple. An $85 billion market cap. Honestly, I thought 3M was a larger company than that. 0.6 beta. And so 58% payout ratio, low for most companies. You notice that that's higher than the other ones we talked about. Those other companies we went through are, in my opinion, dividend growth companies. Their payout ratio is lower, meaning that they're going to have more room to expand that over time. And I would expect their earnings to grow faster as well. The other companies, not 3M. Forward payout ratio of 58, right about the same. Net debt to EBITDA 1.47. Net debt to capital 49%. That is edging high, but that's okay. 63-year dividend streak. They increased it during the great financial crisis. Minus 13% recession sales, minus 54% return. They got crushed, just like the S&P 500. And again, not really a dividend grower, not expecting that. 0.7% in February 22, 6% over the last 5 years, not bad. 8% over the last 20 years. 63-year dividend growth streak, 63 years of uninterrupted dividend payments. Remember how you're feeling right now. I can't give any financial advice, but I can tell you what I'm doing. I am continuing to invest every 2 weeks and own the best companies I can find. Doing this on this channel If that's what you want, if that's what you're into, please like the video. It helps it get discovered and tells me what kind of videos to make. And subscribe to this channel so that we can be on this investing journey together and we never miss an update. Remember, this is information, not advice. Do your own research and stay on the path. Take care of your mind, your body, and your money. And remember, have fun, make dumb jokes, laugh a little bit. That's what life is about. That's why we're investing. See you.